Says we're streaming. Yes. All right. Good. All right.
Welcome, everyone, to Liberty Talk Radio, America's Libertarian Voice, broadcasting from our studio in Tulsa, Oklahoma, to around the world. I'm your host, Joe Cristiano, and this is your antidote to popular talk radio. We're starting a little late because of technical problems. We originally were going to start this broadcast at 2 p.m. Central Time. It is now almost 10 minutes to 3, but we'll continue. We'll go on for about 40 minutes or 45 minutes. Our guest today is a returning guest, one of our favorites, if not our favorite guest, Economist Andy Sutton. Andy was formerly of the financial community. However, now he's involved for the sole purpose of blowing the whistle on corruption and helping people around the globe become their own advocates. Andy, welcome back to Liberty Talk Radio. My mailbox is always open to you. Well, Andy, today we wanted to talk a little bit about some of the economic indicators, many of which are that the mainstream media fails to mention or skims over or uses as a secondary indicator. The main indicators aren't doing well at all. In fact, most of the indicators are bad. The mainstream media seems to just hang on the hat on the fact that, geez, unemployment rate is 4.9%. That's full employment. Everything is fine. We just have not arrived yet. And when we do, we'll raise interest rates. The flowers will bloom and everything will be fine. Now, we know we've been listening to that now for 6 years now, and it has not occurred yet. In fact, if you look at the indicators, and I'd like you to talk about them a little bit, especially the velocity of money, and how long it's been since we've had such a slow velocity of money, and you may want to explain that to our listeners as to what that really is. All of these indicators give us a good feel that we're heading for a brick wall. Am I just a naysayer type guy or a negative thinker, or am I a realist?
No, you're a realist. I mean, this is the thing. And if you go on my blog, andysutton.com, I put a post up a little while ago that has 3 charts on it, and most of the discussion today, I imagine, because these are your favorite topics too, will center around those 3 charts and kind of the ramifications thereof. And we did have an individual name is Paul. Paul wrote in and he asked that we explain the velocity of circulation. And I think that's probably one of the least understood of these indicators. The others are fairly straightforward. But I mean, basically, you've got a situation where, and this is something, I'll post an article and make comments. What we've seen is the media is playing good cop, bad cop with these economic reports. Oh, well, the unemployment rate is good, but there's like almost 100 million people not in the workforce. This last jobs report, well, the economy created 151,000 jobs, we think. But you'll see, they'll get kind of like one good report and then they'll get a bad report. And this is giving the Fed the cover to do what they want to do, which is nothing. They don't want to raise rates. They can't raise rates. They know that. Everybody knows that. Right. All these people that sit there, these guys are a bunch of idiots. No, they're not idiots. These are smart people. They know they can't raise rates. All right, let's think about this for a second. Mortgage rates at 7.5%. What's going to happen? They're 3 and change now. Well, you double those. It's not going to work. You're going to see a massive drop off in borrowing, and that's the only thing that's keeping this thing even maintaining some semblance of order is the fact that people are borrowing money. So in order for people to continue to borrow, and that's going to stop at some point too, but you have to keep it cheap. So the Fed raising overnight rates that banks pay to each other for, these overnight loans. If they were to raise that back to say 2005 levels, which was around 5%, that raises the prime rate to about 8%. You see where I'm going with this?
Right.
It ain't gonna work. So they're not gonna raise rates. Yeah, you might see a 25 basis point or 1/4% raise from them. That's nothing. That's a joke. They did that not too long ago. When I say raise rates, I mean actually raise rates to what?
Not 25 basis points. You mean 1
Yeah.
or 2 or 3%, right?
I'm talking back up to like 2005 levels, or even 3 or 4%. It would destroy the borrowing activity in the economy, and that's what the economy is running on, is borrowing. If people stop borrowing, that's it. You're done. So they're not going to raise rates. So what you're seeing in the media is this constant good cop, bad cop. Well, this, and Yellen will get on there and she'll say, well, this report, this looks very good, and blah, 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 and we may have to look at raising rates, and then the next one out the next week will be, well, that's not too good. And, maybe we're going to have to hold off a little while longer.
Yeah.
If you remember the Barbasol man back in like 2011, 2012, his target was that they weren't going to raise interest rates until 2020 at the earliest. So, we're 4 years away from that. And I honestly believe that they're not going to raise rates. They can't. And these charts that we put up here kind of not prove it, but they strongly suggest that that's not going to happen. They're not going to raise rates. So this whole thing about the Fed it's a non-starter. It's a dog that won't hunt. They're not going to raise rates. I think most of the people that are in this community, they know it. The Europeans know it. Graham taught my co-writer. He talks to an awful lot of people over in Europe. They all know it. It's a joke. Russian oligarchs have $1 million a chance bets going right now on when the U.S. is going to hit the brick wall.
Right.
Basically.
Yeah.
They've turned this into a game, for crying out loud. So this is, this is not good. But let's go over and let's take a look at these three charts. I don't know if you have them in front of you.
Yeah.
Or if you had a chance to
Yeah, I
print
had them
them
on
right.
my screen here. I think I can call them up in a second. Oops. Yes, I have them right in front of me now. There we go. Yeah, the velocity of circulation, GDP, it's a little bit small. Here it goes. There is my eyes aren't as good as they used to be. Divided by the M2.
Yeah. Now, the M2 is the broadest monetary aggregate that the government releases. There was another one called M3, which the government no longer releases since 2006 because they wanted to save the taxpayers' money. But the nice thing about M3 is you can recreate it fairly easily with other numbers that are provided. Basically, it's M2, and then you add some different things to it, and you can back into the numbers on your own, and it's fairly reliable. I want to start there with M3, and that's if you're looking at the blog, that's the bottom chart. And the green line is the M3 monetary aggregate, and then the one that goes all over the place, the blue line, that's the rate of growth.
Right.
All right, and that's what I want to point people to.
Now, Andy, excuse me, what does M3 include?
M3 is pretty much everything.
Okay.
It's cash, time deposits, all that sort of thing. You can go right up the line. Euro dollars, things like that. Some people include different currency swaps in there too. But it's basically all the money that's available in circulation, the digital money, all the dollars in existence.
Does it include Bitcoins?
No.
No, okay.
No, no, no. It's just dollars.
Just
So
dollars.
there's no gold in there, and nothing like that. It's
Okay.
just depreciated U.S. dollars. So you're looking at a situation where that is between 18 and 19 trillion dollars right now. But look at the growth rate, and that's what I want to point out to people here. If you look on the right side, you'll see where it gets down to zero. And if you go back to 2009, 2010, you can see that M3, and then you look at the green line right above it, you can see where M3 was actually contracting.
Right.
So so we were actually having monetary deflation, not price deflation, monetary deflation. The money supply for that period of time was contracting. Now, if you go up to the chart right above it, go over there and look at right around 2008 it gives you, and look what consumer credit did right around 2009 to 2011. You see that contraction in consumer credit?
Yes, there's a slight dip down, right?
Yeah.
There's a skyrocketing straight up, and then it went straight down, almost
Yep.
on a 45-degree angle, went down for a short period of time.
Yep, right at the same time. So here's the thing. When people borrow money, that helps grow the money supply. You take your money, your paycheck, you deposit in a bank, they lend it out, at a factor of 9 to 1, 10 to 1, and hence grows the money supply. When people stop taking out loans, that's not necessarily deflationary in and of itself, but when people retrench and they started paying off these loans, and there's other things that can result in monetary deflation as well. You had a significant contraction in M3, and it threw the policymakers into a panic because they want inflation. That's to them, that's what grows the economy. All right. So deflation to them is bad. For you and I, if we have true deflation, that means the dollars in your pocket become worth more because there's less of them.
Yeah, but during the early part of the 1900s, we had a deflationary environment because we were so productive. Everything we made became more efficient, less expensive, so people were spending less money for items of value that cost them a lot more before. I mean, the Model A Ford, for example, the Model T Ford, those cars with the assembly line became, went from thousands of dollars, and back then that was only in the reach of the filthy rich, to just a few $100s, so the common man can buy them. And then the price of items actually went down. We had a deflationary environment, but an increase in productivity and an increase in wealth of each individual. So we equate inflation with wealth, when back then, when we had a real economy, deflation was associated with wealth. Am I correct, or am I reading that incorrectly?
Well, no, you're right. But keep in mind, though, when the price of something goes down, that's price deflation.
Right.
That's not monetary deflation.
Oh, that's correct. Okay.
Monetary deflation is when you actually lose dollars from the system for whatever reason. Now,
Right.
I'll give you an example of what a good case of monetary deflation would be. The Fed, as we all know, has purchased a lot of junk assets. All right, they've taken them off the balance sheets of banks. The Fed creates these little maiden lane LLC corporations within the Fed to store these garbage assets. Let's say now that the Fed decided, and they purchased those assets with dollars that are created from nothing. Okay, let's say, for instance, now the Fed decides, all right, we want to unload some of it. We don't want to have $4 trillion in our balance sheet. We want to cut our balance sheet to $3 trillion. So they decide to sell off $1 trillion worth of these junk assets. And let's say that they find buyers. So you have the junk assets going from the Fed into the market. The market is paying $1 trillion to the Fed. So you have $1 million that's getting sucked out of the economy, basically.
Right.
In going to the Federal Reserve. That would be monetary deflation. So here's the thing, and this is something people need to keep in mind. The Fed, during the Great Depression, used monetary deflation as a way to, because you had this huge speculative bubble in the Roaring '20s, kind of like you did in 2005 to 2007 in housing. We've seen numerous bubbles in stocks. We've got a huge bubble going on in government bonds, even corporate bonds right now. So what they did is they said, all right, it's time to consolidate wealth. We're going to cause this thing to go boom, basically. And then instead of letting the economy up off the mat, what they did is they continued to remove money from the economy. Now you take too much out, and guess what? There's not enough there to actually lubricate, because that money is like oil, so to speak. You take too much money out of the economy, yeah, you have deflation, the dollars become worth more, but there's not enough of them to actually do the transactions that are required to keep the economy moving. You see what I'm saying? Yeah. You have to have it. You got to leave some money in the system. You take it all out, nothing's going to happen. All right, but that's what they did. And this here, with all these trillions that the Fed is sitting on, they easily have the mechanism available to them, if they were so inclined, to foist on us basically what would result, deflationary kind of depression again, by taking too much money out of the system and not allowing enough there to perform the basic financial transactions that the economy needs to function. So they have ammo to do that if they want to do that again. So, I mean, that's something people need to keep in mind. Deflation is okay to a point. All right, you take too much out, things stop working. All right, so that's definitely something to keep in mind. But here, now take a look at the M3 chart again. Go over to the present, towards the right-hand side. You notice again the growth rate from like here, the middle of 2013 through 2015. That M3 growth rate was up like 9%.
Yep.
It dropped almost down to zero, and there was actually a one period in there. This goes by the week. So there was 1 week in there where it actually was negative.
Yes,
a little bit.
That's right. Yeah.
So that growth rate is dropping again. Then it bounced up a little bit, and then it seems like it's kind of trying to curl down again. So, but look at consumer credit. You don't see that any blip there. I mean, consumer credit's going straight through the roof.
Right.
So what's this about? My hypothesis here is that, and this is where unfortunately politics and economics sometimes merge. And my fear is that, say we would elect Mr. Trump, all right? And the establishment, knows that the people, and this is not my opinion, this is how people perceive him in this country. He's like the pillar of capitalism, even though we know that's not really the case, but that's how people view this guy, all right? If you want to destroy capitalism, what better a thing to do than to let basically the people's choice for the champion of capitalism into the White House? You're sitting on an M3 growth rate that's basically ready to, take a dive here and pitch us right into a recession, or a deeper recession, or something even worse than that. And then you can blame it on capitalism. Oh, look at this guy. He come in there and did this, did that, did the other thing. It's capitalism's fault. We got to get rid of capitalism. We need socialism. So something to think about. I have no foreknowledge or anything like that, but these are the things that that cross my mind when I see these kind of charts, because this drop in the growth rate of M3 is not being caused by a pullback by consumers as far as borrowing goes. Borrowing is the slope of that consumer credit curve. I mean, it's steepening. They're borrowing more and more and more and more. So this is not being caused by a consumer retrenchment. So in my mind, I want to know what else is going on.
But what
Here.
is causing it then?
That's what I'm not sure
Oh,
of.
that's not, well. Let me backtrack a little bit and see if there's any correlation, because I consider myself a very poor closet economist. Okay, I have no degree in.
Actually, you're a very good economist, but
Well, thank you. But when I was growing up, now I'm a product of the 40s and 50s, and of course that's a totally different era. Uh, I recall my mother shopping twice a year. I'm not kidding. We twice a year she would get dressed, and we lived on 123rd Street and First Avenue. I would go with her when I was a kid, and we would go downtown, and she would go to Macy's and Bloomingdale, and she would make her rounds, and we'd have lunch, and we left about 9 o'clock and got home about 3 o'clock twice a year. That was the shopping. Now she did do some shopping where she would call the company and then UPS would deliver the stuff. And we always accused her of having an affair with the UPS driver. We used to give her a hard time, and because the UPS driver was always, but she would return everything. I mean, everything she bought, she returned. She never kept anything. But my point is this: is that back then the emphasis wasn't on spending. We didn't spend money. We worked very, very hard. We put a good portion of money in the bank, into our businesses. How come we were not in a depression when we weren't spending any money? Why was the economy booming when people weren't watching television, and half of television is buy this, buy that, buy that? When we didn't have that mentality, we went to a candy store and spent 2 cents, and that was it for the day or the week, and that was it. It was over. And today, if you're not buying everything and getting a cash back on your credit card and buying a new car over 7 years with no interest, you're not living. And we didn't do any of that. And why wasn't the velocity of money near zero back then? And how did the economy grow so phenomenally when no one was spending money?
well, here's the thing that alludes and points directly at the activity. All right, you worked, you saved, capital was created. All right, capital was you put your money in the bank. The banks at that time, for the most part, especially the smaller ones, were nothing more than a conduit or a meeting place, if you will, for entrepreneurs and creators of capital, which were savers. All right. So your money went in the bank lent it out to, some firm or whatever, and then they went and did something productive with it.
Right.
They built a factory. They employed people. They produced some kind of a product that was needed by somebody. We used to run trade surpluses, back in those days.
I remember that.
So it wasn't necessarily that Americans needed to spend the money. We could sell it to foreigners, and we did. We ran trade surpluses, and so the economy grew because it was based on capital. All right. Today, what you have is we run trade deficits, so we're importing way more than we're exporting, and we're buying this stuff not with savings, not with capital, but we're buying it with debt. We're borrowing the money from somebody else rather than through savings, and what ends up happening there is this debt is created from nothing. The banks can create virtually as much debt as people are willing to have an appetite to take on. All right, under our fiat money system. This is we're getting off the gold standard got us in trouble, and all this other stuff. So you went from this Austrian production, savings, capital formation, allocation of that capital to productive activities. You went from that model to the Keynesian, shop until you drop at all levels, government, national, state, local, and then individuals as well. You went to that model, and that model is not based on capital formation, it's based on debt formation. And that's why you have to have all this borrowing going on to get a measly 0.3% growth in GDP in the last quarter. People are spending money like crazy. But that's the thing. Where's it coming from? That's why the economy's not growing. Because they're not spending capital, they're spending debt.
Well, it seems that now I'm a young 73 years old. Never thought I'd live this long, but I'm 73, and I still work. But surprisingly, I'm still putting money in the bank. I'm still saving money. I mean, I'm not doing anything differently than I did back in 1954. I'm doing the same thing. My car died 3 weeks ago, and it's been in the place, and they finally found out what was wrong with it, and they don't think it could be repaired. And they said, looks like you'll have to junk this car and buy a new car. I mean, I'm going out of my mind. Now, I can afford to buy it. I can buy any car I want. But it's just not in my nature to say, yay, good, I have a good reason to buy a new car. I'm going to buy that Corvette. I can afford a Corvette. I wouldn't buy a Corvette if you put a gun to my head, but I can afford to do it. But it seems like the world is the exact opposite of what it was when I was growing up. People didn't spend money. They saved. They built capital. And it looks like what we're doing now is that we are spending that capital. As people get older, they spend the capital that they saved. And the people that are coming up are not saving capital. They're going into debt. To me, we're driving a car right into a brick wall. I mean, there's no other conclusion I can come to. Is my economics off or something?
No, I mean, here's what happened. I mean, you're doing, like you said, the same things you were doing in 1954. Here's the difference. In 1954, you took your savings, you put it in the bank, and like I said before, it was lent out to somebody.
Correct.
And that somebody, chances are pretty good, did something productive with it. Today, you take that same money, your capital that you've, by foregoing consumption and so forth, you take your capital to the bank, put it in the bank, chances are pretty good it's going to get lent out to somebody to do something stupid. They're going to buy that 40,000 truck, at 7 years, 15% interest, because their credit stinks, whatever. They're gonna do something like that. They're gonna do something that's based on consumption, not on production. Chances are good it's not going to go to somebody who's looking up to start a business, that's going to produce a good that we can export and create a trade surplus or put a dent in the trade deficit. The whole model, you haven't changed. The whole model's changed around you. The world's changed around you, and you're not the only one. I mean, there's lots of people your age write in constantly with questions. What changed? I'm doing the same thing I've always done. What am I going nuts? No, you're not going nuts. It's the world has changed around you. Does that mean you should stop doing what you're doing? Absolutely not. What you need to do is somehow, and I know this is, now we're starting to get into, hyperbole potentially, but more people need to be doing what you're doing, and less people need to be doing what is being done now on a national scale. And I keep hearing, we need to put this politician in office in this state or that politician in office in that state because they're going to fix this problem. No, they're not. The way this problem is going to get fixed is from the bottom up. It's going to be individuals making the choice. Hey, you know what? I don't want to live like this anymore. I don't want to wake up every morning and go to work so I can make payments to somebody. I don't want to get up every morning or lose sleep at night because I have too many payments and I live paycheck to paycheck. And, if there's an illness or, something like that, I'm going to be in big trouble. It's a lot of stress on people, unnecessarily in many cases, because of these lifestyles that people are living. We have this entitlement lifestyle mentality where, I'm entitled to live the way they live on TV.
Right.
And it doesn't matter that I don't have the job to support it. I've got a Visa card, I've got a MasterCard, and I'm going to have it. And nobody's going to stop me. And that's the attitude that so
Right.
many people have taken in this country. And that's why all these charts and metrics, that we're looking at here are the way they are, because of this mindset that's been created in this country. And you know what? And we're not the first ones. We won't be the last ones. The Europeans, they're pros at this. And guess what? Guess what changed their mind? Oh, austerity. Well, a good many of them had the carpet kind of yanked out from under them, because of doing all this stuff, and it got to the point where they couldn't do it anymore.
Yeah.
And that's when I said the Russian oligarchs are placing million dollar chance bets on when we hit the brick walls. When is America going to hit austerity? When's America going to hit the austerity brick wall? And all I hear, this is the stupid season, with the politics and all this nonsense. All I hear is we got to spend more. We were talking about it before the show. We're gonna spend more. We're gonna do this. We're gonna spend money on that. We're gonna spend. What about the almost $20 trillion? That's it that we owe right now. Not to mention generations down the road. What about that? Nobody's worried about that. Nobody cares. That bill's gonna come due.
Well, my wife and I just mentioned my car had died, and we said, well, let's go down Car Road. Memorial Drive is all the main car retailers, Nissan and Honda and all those people, Ford and Chevy, and every single those car lot, and they're very large. I mean, they're just acres filled with cars. There's not a space. You can't park anywhere because they have cars, and they're not customers. There's no customers there, but there are hundreds of cars in every lot. And I cannot believe that they're going to sell all these cars because the 2017s are coming in, and these are all 2016. Where do they put these cars? And then there was an ad on the radio where they said, well, how is, they're having this big sale. I think it was a Chevy dealership. I'm not sure what car it was. But they said, oh, yes, things are going fine, And the TV, the moderator said, well, tell me, Bob, how many cars did you sell Saturday? He said, 1,400. And I thought to myself, 1,400 cars? I mean, you couldn't fit 1,400 people in the parking lot. The place was empty all day, But it's always this push to sell, buy. And what really annoys me is when I watch television, you watch a couple of minutes and then you get about 10 minutes worth of ads, and every ad is to buy. If you're not buying something, you should be unhappy. People say, well, Joe, what are you saving your money for? I said, it's simple. Where I'm going, it's going to be really hot. I got to pay for the air conditioning. I want to make sure I'm cool. And that's my answer I get to everybody. And people say, well, why don't you go on a cruise at your age? I said, what for? I don't see the purpose. Well, to their mind is that happiness is being on a cruise, sitting there with a mint julep or whatever, and then just drinking it and watching the water, and life is wonderful. To me, I was on a cruise one time. I was given a cruise free of charge from my company because we did work with them, and I went on a cruise free of charge. In fact, the only condition on the cruise is I couldn't pay for anything. I went stark raving mad. I was so bored. Never. This was about 30 years ago. I said, never again. And yet people think that that's the penalty. When they get enough money, to put the down payment on a cruise, then they'll go into hock for the cruise that they're going to go on. There's a world that I missed. I can't seem to reconcile any of this.
Well, this is, and you mentioned it, the ads. They don't call it programming for nothing. And that's where the change came. Back in the 50s, most people were like you. They would work, save, maybe do a little, small family vacation or something like that once a year or once every other year or whatever, and that was it. They didn't have, you didn't even have credit cards back then. You didn't, maybe, if you were on good terms with the guy down, that had owned the local hardware store, you could go in and say, hey, Harvey, I got, a little short this month. Can I get you next month for whatever you need?
Right.
Yeah, he might say okay because he knows you and it's a small town, but you didn't have all this credit and all these ways of borrowing money. I mean, you can take out, whoever thought of a home equity loan back in the 50s? And this is the creation that the financial establishment has come up with, all these different gimmicks to get people to go into debt. And I call it neo-feudalism because
Right.
I think that's where we're headed.
Yeah.
I think we're already there. The lord, serf, vassal, slave kind of thing. We have debt slaves in this country. I mean, yeah, you're not, in chains, literally, but figuratively you are.
Yeah.
When you wake up every day, you go to work, and all of the efforts of that work for that day go to pay various creditors. Yeah, I think you're a debt slave. And people haven't made that connection yet because they can have all these things and all of that stuff, and so you get to the point where they don't even think about it that way. But here's the thing: you go up to that top chart, velocity of circulation, and basically what that is, and this is telling us that what you have going on here is basically two Americas. One that's doing what I just talked about, shop till you drop. The other really isn't doing much of anything. The velocity of the circulation is basically how fast the money moves through the economy, or how fast a particular dollar moves through the economy.
Yeah.
So if you had GDP growing at the same rate as M2, if you're looking at my chart, if they were growing at a 1-to-1 thing, GDP divided by M2, they grow by the same amount each, you're basically going to have a velocity of 1. So that's what you're seeing. We're getting down to that point where the only reason GDP is growing is because the money supply is growing.
Ah, okay. All right.
It's GDP growth is growing as a function of the fact that M2, which is the second broadest monetary aggregate, is growing.
Yeah, more money in its circulation.
Yeah. So guess what? The implication there, you stop growing M2, GDP stops growing.
Stops
economy
growing,
stops.
right.
Yeah.
Right. Yeah,
So
here's,
this is why they'll never raise rates also, because they need inflation. All right, they need inflation. When you raise rates, what do you do? What did Paul Volcker do to stamp out the inflation that they had, the runaway inflation that they had at the end of the 70s? They raised interest rates, didn't they? They raised the Fed funds rates of like 19% or whatever it
I know
was.
my house mortgage was 8.75%.
Yeah, they raised rates to stamp out inflation. But now they're in a problem, and the Europeans are having the same problem. They can't get enough inflation.
Right. And if
To
they
make the
raise
pa-
rates, the government, the interest on the government debt goes up, and then the government have to file bankruptcy, and then it renders your currency worthless.
Well, then there's that too. But this is another reason why they're not going to raise rates, because if you're in an environment where you're a central banker and you've been programmed by this idiotic Keynesian, model, you need that inflation. And if you're not getting that inflation, you're not going to raise rates.
Right.
You're going to do quantitative easing.
Right. Yeah.
Because you can't lower rates anymore because they're already zero. So, or you talk about, well, we'll do negative rates.
Excuse me, we have a caller on 918. All right. Hold on, please, Andy.
Sure.
We have a caller with area code 918. Caller, did you want to ask a question or make a comment, or are you just listening in? Caller, are you on the air? Caller? Did you want to ask a question or make a comment? Area code 918.
Yeah, Joe.
Oh, Lloyd, yeah.
When did the show?
Lloyd, I just want to make,
when did the
if you
show
can make it
start?
very quickly because we go off the air in about 2 minutes, okay? Go ahead. Go, Lloyd.
Okay, well, I wanted to ask Andy, I get a lot of this alternative news and such, and I was just wanting to put a date on my calendar when Andy thinks that Deutsche Bank is going to collapse, and then, of course, Societe Generale and UBS and HSBC, because I want to mark it on my calendar when I can see this stuff happening, so I'll know when to get everything out of the market.
Okay, great. All right, Lloyd. We're going to Andy, if you answer the question right after that, we're going to have to close it out because we're running out of time. We're going to be knocked off the air. Okay, go for it, Andy.
Well, I hope he's joking because
Of course he is. I know this guy. He's called in before, but
Yeah.
he's a brilliant guy. He knows what's going on.
The Deutsche Bank has been helped out at least 3 times, and I know that for a fact. I don't know when they're going to hit the mat. They may not hit the mat. They may continue to quietly prop them up. The fact that they're in the shape that they're in, along with the rest of the banks that he mentioned over there, that enough ought to be an indication of what people might consider doing with regards to the market. Yeah, it's becoming laughable over there, really. You know, and I think another country or two does a Brexit and decides to, vamoose out of the EU, and I think you're going to see the curtain close on that whole mess.
Okay. Andy, could you wrap it up in about 15 seconds because we're going to lose our line? Okay.
Well, I didn't. Unfortunately, we didn't get to explain a lot of this stuff. But the good news is, Graham and I are going to be coming out with a piece that's going to focus on a lot of this stuff. I will try to explain it better in the piece and make sure we get the circulation thing nailed down for people. www.andysutton.com. Keep an eye on the blog. It'll be up soon.
Okay, Andy, we're going to have you on sooner than we normally would because we had such a foul up this time with our electronics, and we'll have you back real soon, okay?
Sounds good. Thank you very much for having me.
Thank you for being guests. All right, folks, this is the end of today's broadcast. We'd like to thank our sponsors for the financial support, and we'd like to thank you for listening in. You can further the cause of liberty by recommending this program to your friends and let us hear from you. Our email address is comments@libertytalkradio.com. Remember, either allowing your liberties to be taken away or you're striving to protect them. Unfortunately, there is no middle ground. Until next time, this is Joe Cristiano. You've been listening to Liberty Talk Radio. Stay well, stay tuned. We can turn up the sound of the camera. We don't need sound. I mean, we don't. No. We do not need the sound on the camera. Yeah. And I'm sure they can be turned off. If it's switched there somewhere, I'm sure it can be turned off. There's no reason not to have it switched. We take that off. We should be okay. Does Kirby know how